The title of this session is To Sell or Not to Sell? That is the question. And we are hosted today by the very own grandfather, godfather, and my friend. Oh no, Simon, I'm sorry. The godfather of vacation rentals, Simon Lehmann.
That's why you want
Hi, buddy.
Well, thank you, Sarah. My oldest daughter is 24, and I just learned something. She might be pregnant. No, but she's not. Thank you, Sarah. Nobody ever called me a godfather or a grandfather. Grandfather? Yeah, grandfather. Okay, great to be here. Thank you for sticking around to the graveyard shift of this amazing event, the Short Stay Summit in London. I hope you all enjoyed it. And I'm really pleased to close this off with an M&A conversation of some very large property management companies with different strategy. So we'll focus on creating value creation, buy versus build, and what is exit reality ultimately within the current market environment. So please join me in welcoming Jennifer Day, Chief Growth Officer of Awaze, Christian Schwarz, co-founder Landfolk from Denmark, Alex Limpert, co-founder and CEO of GuestReady, and Constantin Schroeder from Arbio in Berlin. Thank you very much.
Thanks for having us.
Great to have you. Give them a huge round of applause. They're super nervous, but we're going to make this very enjoyable together. Thank you very much for joining us.
Thank you.
It's amazing. 4 incredible businesses, incredibly different from each other at the same time. So I'm really, really looking forward to that. So for me, the core question today is, what is the best way to build value in the property management business today? Because one thing, I just had a CEO roundtable, we talked about value creation is the core asset right now that we can do, the core strategy in our industry, because ultimately there's not really a buying market right now, and it's not a seller's market right now. So in relation to transactions, it's pretty tough out there right now. Like, whoever wants to sell, what is your strategy? Why do you want to sell? What is the value that you can create? And that's what I want to focus on with the panel today, to talk about value creation for your own businesses, and how does that translate to property managers out there today. So, Jenny, I want to start with you. You're the Chief Growth Officer of one of the largest property management companies in the world, and in the UK, of course. Where is your focus as a Chief Growth Officer, which is not entirely M&A, in terms of creating value for the business today?
Yeah, thank you. Thank you for upscaling us to be the largest in the world. I quite like that claim.
I think you are.
We're working on it. No, hi everybody. So I think our big focus, as you said, we're one of the largest in Europe. We represent over 100,000 properties across 20 countries. One of the big priorities for us is growing our direct businesses. So we have some incredibly important direct brands across some of our core markets, and they're important for us because they enable us to attract customers that keep holidaying with us. So when we look at acquisitions, we look at opportunities to grow supply with demand that's incredibly sticky. So we're very conscious about retaining those relationships with owners, reducing churn, so that we can support the growth of those direct businesses in those markets.
Is that equally balanced when you look at these businesses, buying supply, but at the same time you're buying very good demand with an acquisition as well?
Yeah, it's a really good point. So one of the things we worry about most is, it's not the case of build it and they will come. We need to make sure that we can match supply with audiences. It's really important to us that we don't dilute occupancy. We have a responsibility to deliver for our owners. So whenever we acquire new supply, we need to make sure that we've got, incremental demand and audiences that are interested in that supply. Yeah. So we'll look at things like, honeypot locations that allow us to go, deeper into markets that we're already established in.
Alex, I want to go with you next. You guys have been pretty acquisitive. You have been very spread geographically as well in terms of GuestReady's approach, building your own technology. We won't talk about that today. So how do you look at that country, like in conjunction to what Jennifer just said, when you look at acquisitions and creating that value for GuestReady today?
Yeah, I think it has also changed a bit over time. I think the value depends on how the market overall values companies, and in the past it was more on revenue growth, maybe on the top line, and over the recent years it's shifted more to the bottom line. So when we think about value creation, the advice that I can give is probably by building something that somebody else wants, but it's harder for them to build than to buy, right? And if they would want to build it themselves, it would cost more than if they can just buy it. So for us, we've done 12 acquisitions. When do we like to look at acquisitions? Well, it's either maybe going into a new market.
As a market entry strategy.
Exactly, market entry strategy, where we know it's actually hard. Every single market, maybe new language, new culture. The existing brand that we have is not as well known in that new territory. Or we look at, is it a location where we're already present, but it's very complementary and we can unlock some cost synergies or some revenue synergies, some efficiencies. So these are some of the acquisitions strategies that we've been looking into. But I would also say, more generally, it's a lot about the portfolio, the quality of the portfolio, the profitability that this portfolio brings. Our inventory is not is more, I would say, mid to premium range, but it's not like ultra luxury, ultra specific inventory. But I can see how, for somebody that is focused on that type of inventory, and you have exactly that kind of inventory, that can be very valuable. So I think it's a lot about the inventory and how durable it is and what it will deliver over time.
Constantin, I want call you. They call me the grandfather. I can call you the new kid on the block, right?
The grandson.
So, from Arbio out of Berlin. Super interesting what you're building as well. It was great to have you on our podcast too. And you've been extremely acquisitive. You raised a shitload of money, a lot of money in your Series A, right? And you've been very acquisitive. So what is the core in terms of now creating value through the acquisition that you're doing?
Yeah, so we've done over 30 acquisitions in the last 3 years, and it's a muscle we've been building since day one. So 80% of all our units have come through acquisitions, actually. And the reasons why we do that is twofold. So we think speed, we think we can be a lot faster in growing if we actually acquire, and accessibility. And I think accessibility is really what Alex also kind of mentioned, is how do you get access to markets that are regulated sometimes. So we've done a lot of acquisitions in cities where it's very difficult to penetrate organically. It takes a long amount of time to get the licenses. And so we think that in cities, acquisitions can be really interesting to get access. Then it's access to owners. We see companies that have really great connections and relationships to owners, and we think they are extremely valuable and hard to recreate as well. And then number 3 for us is networks, looking at countryside, especially the experience and the knowledge that these kind of companies have is extremely interesting for us to understand how we can grow there, how we can capitalize on owner networks. So that's why we do these acquisitions. And then post-acquisition, I think you were mentioning your question as well, it always depends on the asset we look at and we acquire. There's really different value-add strategies. Sometimes we see very, very nicely run companies where it just needs some capital to grow the business. Sometimes we see a huge potential to uplift the performance through technology. So it really depends on what company it is and how we can create value. But it's always one of those two in our case. So it's either technology or it's capital to grow the business and to help the business just keep on doing what it's doing.
I come back to you later on value creation in terms of retention. We talked about owner relationship. We'll go on that in a second. And we can also call you the new kid on the block, right? So, Christian from Landfolk, I mean, coming out of nowhere in Denmark, basically building a nice and quiet, a huge business, and you're not acquisitive at all, right? We can say, and we talk about buy and build in a minute, but where is your focus on value creation within your business where it stands today?
Well, yeah, no, we are not that experienced as these guys in terms of acquisitions. We've made one, but we're very mindful about, whether it's better for us to build or buy, right? And I think we have invested quite a lot of money and resources into building a brand that attracts a lot of inbound leads. So 90% of all of our supply comes through inbound leads, and we convert those to listings, right? And I think for us, we're really trying to look at this in a balanced way, because obviously acquiring gives us a lot of speed of execution, right? It's like a bridgehead into a region or a market in a very fast way, right? But we measure, on the CAC payback, on each listing. And for us to really own the deep relationship with the host from the very get-go is very important, right? And when we buy, we have to, move through. I mean, the owner of the company has to kind of mediate, and build that relationship with us in order to prevent the churn, right?
Yeah.
And I think it's just a hard one, right? Because very often we've seen, also the cases we've looked into, that the owner has very personal relationships with the owners, right, or the homeowners. And it's really hard to pass on relationships to a huge company, unknown company from Denmark, right? So I think for us, it has been very valuable to really build our way into the different markets and regions that we're in. And I think those deep relationships really translate into real value for us.
So Jennifer, in terms of Awaze, you've been acquisitive in the past, but you run a massive business, many different brands.
Yeah.
So we talked about value creation right now. How do you look at, you're private equity backed, obviously. How do you look at the M&A market now in terms of acquisition versus organic growth? And why would you potentially reject deals as well?
Yeah, so I think, as you say, we've got a real history in growth, through acquisitions, particularly in some of our core markets that have really complemented, quite established businesses. Croatia's a good example of that. We've also invested substantially in making sure that we've got a platform that means if we do acquire, we can, leverage those synergies quite quickly. I think the areas that we are, acutely aware of now is the point that was being made here, really, is that you can, in taking advantage of your synergies and consolidating onto platforms, you can potentially put at risk those really important relationships, because it is a relationships business. And so for us, when we look at acquisitions now, we look at where there's exclusive contracts with owners, where there's some longevity in the model that means we're not just reliant on the proprietors of that business, that it can live beyond them, but also that it's additive to what we do. So, one of the areas that we're particularly interested in is access to new destinations that meets audience demand for new corridors. So that's, really complementary to our sort of network expansion plans. Yeah. So they're the kind of things we'll look at, but with some caution about making sure that you retain the value as you start to integrate into the business.
Alex, buy and build, organic versus acquisitive. What are you guys looking at? You're pushing more deals away due to other challenges like integration. How quickly can you generate the value for your business while making an acquisition? How do you guys look at that?
Yeah, it's true. I mean, we looked at many more deals than we made, and I think that's probably how it should be, because if you do too many deals, then you probably do the wrong deals. But I would say that the points that you mentioned, like how quickly can you build something yourself? I mean, one point that would come up probably anyway on this panel is scale, right? And when we look at deals and we're looking at 50 units versus 200, then we tend to prefer the 200-unit deal, because it takes the same time to evaluate, to negotiate, and so on. Can take a lot of time, right? Because this is somebody's business, they really care about it, and we truly understand that, and we do take the time to understand the other side. So the more time we invest, the better return we need to expect, and if it's a bigger deal, then it's more worth for both sides. So that's one aspect, and yeah, I mean, just to add on that side. Yeah.
Why do you turn down deals?
I think that the main point is if we either, like, I mean, obviously in the end it needs to be a match between the expectation of somebody and our expectation of what we're willing to pay, and what we're willing to pay depends on the value that is being created. And if we believe that the value is not, doesn't have longevity, I mean, this is actually a word that came up a few times here now, but if we believe that maybe there will be churn or there's too much risk because the relationships of an owner are very strong, but they want to leave the business, and then you don't know what's going to be left of that business in a couple of months or a year, or there's the risk of regulation coming in somewhere, right? In London, regulation is a big topic now, but we've seen this across the board, Barcelona, in every market, and if your portfolio is prone to such a regulatory shift, then that's a big red flag for a buyer. So there's a million things of why maybe we're hesitant to do a deal, or yeah, the numbers don't look so good. It's not very profitable at all. Many things.
We would just,
Sounds very painful, Constantin.
yeah, I mean, I can add some stories. We were just talking to a seller that had bought, I think, 3 or 4 Ferraris from their profit that they were doing, and it was very hard to reconcile what was actually their P&L and his P&L. So those are reasons why you would sometimes say we don't think that's the right match right now. I think regulation is one point. I think location is the most important one for us. I think we...
So yeah, talk about value drivers. That's interesting. Yeah.
Exactly. So we really kind of what we essentially believe is that if location is a star, then everything else around the business can change, and we are ready to make a lot of trade-offs if location is really, really good. And I mean, even investment into property, so the state of the property as it is at the time when we buy the business, is something that can change, and which is a monetary question, a financial question, but location is a complexity that you can't solve. And I think that's really the core kind of we look at when we buy a company, and how has the historical performance looked like in that business. That really gives us a lot of confidence in how the future also looks like. We really deep dive a lot into kind of these performance data on location level to understand how that's looking.
Mm-hmm.
Yeah, totally agree with the different evaluation criteria that you set up. I think for us, we are curated marketplace, right? So we turn down 50% of all applications. So that also means when we have acquisition offers, we basically start by plowing through all of the different listings, and then we kind of measure them up against our brand criteria, right? So if they are not a fit to the brand, we can't use them. And that means that effectively maybe we'll turn down 80% of a portfolio, and I mean, no owner wants to sell only 20%, right? No. Because we're just separating everything, all the good stuff.
No.
So that actually is also a reason why we haven't made more acquisitions. It's really hard to find an entire portfolio of 100% good quality. and otherwise we have to turn maybe 80% down. So that really doesn't work within an M&A model.
I think to add to that, it's as quality and the fit, and also something that we as a buyer understand if it's too far away from our model. So let's say you have an amazing corporate lettings business that is entirely phone-based, and we're like super tech-enabled, everything is automated. That's not a great fit for us. So you might have a great business, very profitable, but does it fit with us as a buyer? And I think that's also what you said, like the units need to fit to what you're building already, to your brand and to your strategy.
I think
Constantin's brain is going, oh my God.
No, I think we've seen that in the past, and I think that's also one of the key learnings we've seen from large roll-up plays in that market is that brand can also be a pain in the ass, I think, in the end, for multiple different reasons, whether it's kind of what guests expect from the stay actually, and building a global brand means that whoever's staying in that apartment also expects a certain level of quality, right? And it also means that you turn down a lot of growth, and you're very selective about it. And we've chosen to go a slightly different path, where we say there are so many great property management companies in the market already, whether premium, whether very standard or easy kind of level, we think they're great companies and they have a right to be in the space. And if they've been doing great in the past, why not support them on growing in the future? And so we're very brand agnostic. We don't think Arbio is the parent brand which dictates everything.
Okay,
but we
so
want
you
to
maintain local brands.
Exactly, and we want to maintain multiple brands that we up-level, that we give maybe a small polish so it looks more like 2026. That's something we do quite quickly, and that's really needed in some of these cases. But we want to be more of a collection of multiple different brands, and have chosen that path for us. And there are so many travelers out there that are only ready to spend 50, 60 euros per night, and we still want to cater to their needs. So that's where Arbio positions itself in that space.
Jennifer.
Yeah, we've got a slightly
with
different
18 brands,
experience.
get very messy,
yeah,
right?
That's right. So I think it's interesting. Our experience is there's a different relationship that the owner has with the brand than the guest has with the brand, and that's something that's through acquisition really interesting. I think owners often see that local brand as a sort of authority that you understand the area and you understand what their property has to offer. So those smaller and sort of more local brands are important to the owner, but that's not necessarily where guests are coming from. So one of the things we focus on heavily is how do we think about source markets, how do we think about consolidation of brands in such a way that you can get your marketing spend to work much harder for you. So that's really important for us as a scaled operation, that we're able to grow volume to meet the occupancy demands of 100,000 odd properties. You need to get your marketing spend to work really effectively in all of those source markets. So having multiple brands is a real challenge in that context. There is a place for it, though. We have some real niche brands where we've made very deliberate decisions. Yeah. They're a niche brand, very exclusive, sort of premium inventory, and therefore they ought to stand alone, and they perform very well.
Yeah, but from your current maturity level, you would not expand your multi-brand strategy at all, right? No. So you probably, when your corporate biz dev team comes to you, you're probably the party crasher, right? Right? Because they say, hey, this is a great deal, we should buy that, and Jennifer says, nah.
No, I think...
Is that how it works?
Yeah, I think that's right. So, some of the things I've said already, I think the exclusive relationships with owners, just how secure are those relationships? It's back to the sort of build or buy question. Could I acquire those relationships directly myself? And what's the risk of losing those relationships over time through consolidation? So that's a really important sort of stress test for us. And then, if it just, in effect, distributes your marketing spend in a different way, then that's, less effective for us.
Alex, what is a good business with the exception of price for you?
What is a good business with an exceptional...
With the exception of the price. Yeah. That's always too high, right? If you're acquisitive, obviously. What's a good business for you? And maybe go a step further, what could property managers out there think about if they consider a potential exit? I mean, obviously you don't want to buy a messy business, right?
Yeah, we like businesses that are in a market that can have scale, where you can have economies of scale in a single market. We typically like destinations that are not too seasonal, because what we do is full property management, and doing that in a very seasonal destination brings a lot of complexity. So we like that. When it comes to the market, we like stable regulation, so a market that has already been regulated and the player has shown that their portfolio is compliant with those regulations. We like it when we see low churn, high owner retention. I would say the lease model has gotten a bad rap, but one advantage of the lease model is that actually the owner retention can be very, very high. Yeah. So we've seen some businesses that had incredible leases, locked in many years ago, right? I'm not sure how easy it is to find incredible leases now, but it has been possible in the past, and I've seen such businesses. So that can be very profitable and have a very long customer lifetime on the owner side. These are some of the aspects that we look at, and that I would say makes a great business. What is also great if we see that there's a brand towards guests and a lot of direct bookings. I think that's even more important for some other brands probably than for us, but that's also something very, very good to see.
Yeah, I think I would totally agree. I would add, like for us, the security or like projectability of cash flows into the future. Like how secure are they, and how much can we actually trust that the business will be running in 5 to 10 years still. And for us, the kind of key components and hard criteria, as you said, are regulation. I think some others that we really value are like owner relationships. How close are they, and how happy are the owners? Something we always test before acquiring, because that is generally a very good indicator of how well the business is doing, how their kind of work ethic and kind of their culture is, but also how well they're doing on revenue management side. We don't care as much around profitability and technology, because we think that's what we can bring to the table. And we're very happy to project that into the future and partner with sellers to find kind of ways around that. And we also value data a lot, so kind of some healthy way of tracking what's going on in the business, so we can apply our technology quickly.
Christian, what gets you excited? I mean, obviously you haven't been acquisitive. You have a very focused organic growth strategy as well. What would be an ideal fit that would drive you? When we talk about buy versus build, we talk about speed of integration and cost. We add in complexity. I mean, there's a lot of other things to consider, right? I mean, if you're on a multi-brand strategy, it's a little bit different, but you still want to create efficiencies with technology and everything else. What would get you excited about a business, and what are the deal stoppers for you?
Yeah, I think there are lots of different things, right? I mean, can we bring more efficiency? Can we, do an uplift immediately of maybe 10% point on the revenue side, just by bringing them on to our more efficient revenue management setup? That would be one thing. I think using it as a bridgehead into a region that might be hard to somehow penetrate or get into, having the owner's perspective on how to grow further, as we've tried as well. I think that, and really, carry the owner into the company and make that person stay as well, to utilize that knowledge is very important. Yeah, so we've been working with, and I think that's another part that excites us, if we can work out a deal structure that is, of course, mutual beneficial, right? But be creative on the deal structure, and I think that's also what the times are calling for, more creativity in terms of deals. So I speak of, sample of one, right? So I can only give that. I know Constantin is much more adept on that one, but so having maybe an upfront payment, but then also doing an earn-out, a rev share as well, to keep the owner on board, and also a warrant structure as well, as kind of having a more holistical perspective, not just thinking about their own portfolio's performance, but also of the wider company's performance. I think you have to really think about those different components in the deal structure, so that all of the stars and moons and planets are aligned. And that's really something we have strived to do, but only with one case, right? So I don't know how you guys are thinking about deal structure.
Yeah, you mentioned that the owner staying around, and I think that's also something that can be very exciting if you see somebody that actually wants to continue going, and they actually know the industry super well, and they want to apply their knowledge. And we, for example, we did a deal in Portugal in 2021, and we acquired a company with 600 units, and we had 100 or so already in Portugal. Now we grew to 2,000 in Portugal, and it's been a very good win-win relationship, because that local entrepreneur that joined us, he knew the market like nobody else, and we brought the technology, we brought the structure, we brought kind of the global brand, and he brought the local knowledge, and together we've created something very successful. And we've just announced an acquisition earlier this year in Canary Islands with 200 units, where it's sort of a similar structure, local entrepreneur that has ambition to continue to grow the business, but they need more capital, they need a better system, they need a global brand and structure that backs them up and kind of frees them up to do that next leap of growth. And that's something very, very exciting. And if you can then marry that with a transaction structure that incentivizes that, like a revenue share or a profit share. I mean, in the past we did more revenue share. Now we're looking more at profit share as well, or a combination of the two. I think that aligns the incentives pretty well then.
I think that's right. Our experience is, these local relationships on the ground are incredibly important. I think particularly with a changing regulatory environment as well, to understand what's happening in your, for us in those particular destinations, and to have really great relationships with the local tourist boards and that sort of thing. Incredibly valuable.
So let's talk about deal structure for the last few minutes. So you don't want to deploy a lot of the capital that you raised, so you make cheap deals. That means you roll in 80% equity and give a bit of cash, or how do you... or does that vary in terms of...
We're very flexible generally, and I think the point being made is it depends on what the seller and owner of the business really wants. We're always cautious when the seller wants to leave very, very quickly and done and dusted, just buy. Then we look a little bit deeper into things. But if we have the feeling they're hesitant to sell and they're very much loving what they're doing and see a huge potential, then that's also how we reflect that in the deal structure, where we say, let's add some variable component, and if the seller believes in what we are building as a company, we're also very open in kind of giving them shares in our holding, just to increase the value uplift that they can get in as a whole, because typically one part of building a large company is that you're valued in a different kind of multiple area, right, and environment. And that can be something very, very interesting for a seller at small scale. So we're very open to that. We've done all sorts of these things, and it really depends on what the seller of the business wants and what the trajectory of the business is.
I have a closing question for all of you. There's obviously a lot of property managers thinking about selling, thinking about buying. With all your experience, what do founders of a property management company misunderstand about selling? And I want to ask this question to all four of you.
The price.
Thanks, Christian. Okay, accept price.
Okay.
Who wants to go first?
I think for me, it's, sorry for catching the word, for us, it's like investing into technology, because I think building your own PMS, building your own tech stack at that size, or a smaller size, is like a huge detour from actually running a good business and making sure that owners are happy, that there are strong relationships, that there's some kind of brand angle to the business. Those are all very traditional kind of senses of ways of building a business, and that's what we really value. All the other things around technology, I think there's either great companies out there, software companies you can use, or larger companies out there that have a kind of a little bit of a better scale on applying technology.
Alex?
I would say, especially on the smaller scale, that sometimes the business is very much you, and if you leave, then there's no business. And I think that's the tough part, and that becomes less if there's a professional management or if there's a much larger structure where not everything depends on the founder. But I've seen this being misunderstood a few times.
Interesting. Christian?
Yeah, and also if you get to keep the owner on board, I think the change management perspective of going from owner to employee, I mean, if you have been independent for 20, 30 years, it's actually very, very hard transgression, And I think that has been a very tough one in our instance to drive that change.
Yes.
Yeah.
Yeah, I was going to say something very similar, and I think if the owner stays with the business, for a scaled business like ours, when you're starting to consolidate and leverage, common platforms, common systems, it means that you sort of give up some of that localized, sort of more nuanced way of doing things in service of something that's scaled. That's difficult sometimes for an owner, to come into the business and see, we'll be doing revenue management differently, we'll be marketing your property differently. So it's just getting comfortable with, that's about extracting value at the end of the day, but it also means doing things differently to the way they've done it before.
We would have a lot more things to talk about, but unfortunately time is up. Jennifer, Christian, Constantin, and Alex, great round of applause. Thank you very much for your insights. It's been fantastic. And I'm now handing over to the grandmother, to Sarah, and to Leo. Thank you very much, guys.
Thanks.